While the European debt crisis and the will they or won't they default game has been grimly fascinating, the global economy and its prospects of late seem to be viewed entirely through this badly fractured prism. It's true economic growth in the developed world has slowed to a crawl, but there is still growth. So are things really that bad? Neil Woolrich reports.
It's been a familiar sight for months. Protesters filling the streets of Athens, angry about the ailing Greek economy and the government's planned austerity measures. Now Americans are descending on Wall Street and Washington, railing against bank bailouts, executive pay and the US's own stalled economy.
The recovery is close to faltering. We need to make sure that the recovery continues and doesn't drop back, and that the unemployment rate continues to fall downward.
The Eurozone is in crisis. The French and the German economies have slowed to a standstill. Even mighty America is questioned about her debts.
That's left investors clueless about what's happening next. The uncertainty was highlighted on Tuesday when a 2% loss in early trade on the US market was followed by a 3.5% surge in just the last hour of trade.
Well, there's definitely been a softening in the data, Neil, over the last several weeks. However, I do sense that the financial markets are pricing in a fairly significant slowing in particularly the so-called developed countries and most pertinently in Europe.
Everything depends on Europe. I mean, we're in a state of flux. The sentiment indicators are reflecting the situation in Europe. The hard data is kind of still hanging in there.
However, there seems to be a growing gap today between those sentiment indicators, which are in the depths of despair, and the hard data, which is solid, though certainly not spectacular. In its latest forecast, the International Monetary Fund is tipping global growth of 4% in 2012. But it's a tale of two halves, with developing economies expected to expand at 6% and advanced economies plodding forward a mere 2% next year.
The most populous nations in the world, namely India and China, will continue to contribute an ever-increasing amount to global growth. And the so-called submerging world, those nations with too much debt, will in essence stagnate for some period of time as they go through this painful process of deleveraging.
I think the economy overall is holding up quite well, all considered. Certainly growth slowed relative to the first quarter of this year or even late last year. But we need to remember that we've had some quite serious natural disasters, the Japanese earthquake, and that's estimated to have knocked off about 0.5% to 1%.
In the last 6 months or so, the pace of triangular shipments have decreased a little bit, but not that much. Europe is still reasonably strong. But America is still a bit of a basket case.
Richard Dexter runs a local freight forwarding business in an industry with its finger on the pulse of the global economy. He says customers have been making fewer shipments of full container loads, and the shipping companies themselves have been forced to lower their prices.
And they are actually struggling to fill ship space. So we're seeing rates now, particularly China to Europe, are down around 35–40% lower than this time last year.
ICAP senior economist Adam Carr says the main problem is a lack of political will in Europe to solve the continent's debt crisis. He argues European leaders need to provide immediate assistance to Greece, but not through a default.
Look, it's a big problem. We can still pull through this. Fiscal consolidation by itself is a good thing. It's not going to drag us into a recession. But ongoing uncertainty in the private sector certainly does have that power. So we really need to watch that space rather than austerity and fiscal consolidation, which is required.
But market analyst Jonathan Payne has a slightly different view, arguing that a Greek default is inevitable. He says the markets are now waiting on German Chancellor Angela Merkel to take some leadership and support the Eurozone leaders who've argued to recapitalise the continent's banks.
And this is a final recognition and acknowledgement by politicians in Europe that the problem is a very, very significant one, and they need to join together in a coordinated fashion and show some political leadership. And I think the financial markets in the last 72 hours have breathed an enormous sigh of relief.
And if Europe does come up with a firm solution, market sentiment could shift dramatically.
Absolutely, and we've seen that over the last few days. We've seen what can happen if people feel even marginally more confident on Europe, and that's based purely on speculation. So if we see something substantive, we will see a marked improvement in market sentiment, in business sentiment, and I think that'll occur very rapidly.
Away from Europe, some investors are also worrying about the engine room of global growth through the past few years, China. Authorities there are trying to cool its overheated property market with higher interest rates, which some fear could lead to a sharp economic downturn.
I don't subscribe to that view. I do believe that we're likely to see a softening in Chinese growth, but ultimately I think growth rates of 7 to 8% in the second largest economy in the world will be a positive outcome.
But that depends on Chinese authorities engineering a soft landing, something that has been beyond many developed world central bankers for decades.